The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stock Take. My name's Nick Cummings, and joining me today I have Angus Donohoo, and also joining us all the way from Canada, Senior Analyst Graham Witcomb. Let's get straight into it, guys. And as we're recording early Tuesday morning, the markets are in a spot of bother. The ASX yesterday fell 4%. The Japanese market fell 12.5%, which was the largest single-day fall since 1987, which is just, kind of incredible.
Crazy.
Yeah, and my own indicator of sort of fear and panic was set off last night when a few mates started texting me about what's going on and should they sell this or should they sell that. So I thought this morning we might start the conversation with just to get everyone's thought about what they do and how they manage these periods, if there's anything special they do. Graham, we might start with you. Have you got any tips to managing this sort of market turmoil, or do you just switch off the noise and focus on what you've been doing?
I think it's definitely worth remembering that the best opportunities always follow when other people are scared. So when you have that kind of at the front of your mind, I think that immediately makes it a bit less scary. I don't think you should be taking note of what everyone else is doing beyond using that as a reason to kind of get excited. So yeah, in these kind of periods, that's when you want to be a bit more aggressive generally.
Yeah, and I find myself, I try and put these things in a bit of perspective. Like, despite the falls, the S&P 500's up 10% this year, which is, still a great return, and the ASX 200's flat. So it's we were at all-time highs 3 weeks ago, and now everyone's suddenly panicking. I don't think that anything's wrong. I think it's some of these things are just sort of a healthy correction. Gus, do you have
watch tomorrow? It's going to crash completely, and
I know.
Podcast will be invalid.
Yeah, I mean, it was an extraordinary evening, really, just sort of watching the VIX go up to 65, and so the VIX is this fear or uncertainty index. Essentially, it's mapping volatility, and it hit the highest level it had since the peak of the pandemic, and then prior to that was the GFC in 2008, and the chart of it is really quite extraordinary. There was just so much kind of chaos. But I think a key thing is to just sort of try to not get emotional. My own personal approach, if I'm buying anything, I like to think about it for at least a week. And so, if you're someone who's a trader, then maybe you are literally kind of leaning into that emotion and you're really trying to make day-to-day decisions. But I try to separate my decisions because I found earlier in life that whenever I've tried to make a decision based on emotion or when I've been caught up in a moment, I've usually lost money. So it's really, I think, kind of critical to try to take the emotion out of it, because one thing that's you've really got to remember with anything like this is it's actually so difficult to understand the drivers in volatility. There's all sorts of factors you can point to. The Japanese central bank finally lifted rates for the second time in decades or many years. There's this huge uncertainty in the Middle East and what's happening there, but there's also going to be currency speculators. One of the things that was so interesting in the sell-off yesterday was that there wasn't really like a safe haven. Gold came down. I mean, gold's trading up at a record high, so maybe that was why. The cryptos sold off 10-20%. So much for kind of Bitcoin being the safe haven in that situation. But it was sort of difficult to see, where the flight to safety was, which I suppose just reflects why there was so much volatility in the market, because there was panic. But to your earlier point, if you look at how far it's run over the last year or so, I mean, I guess one way of thinking about this is you've kind of just lost the full year's gains in a lot of different categories of a lot of different sectors of the economy.
Yeah, and I probably try to take really a long-term view. I'm not much of a trader. I try and hold everything, or I envision holding everything I own for at least a couple of years. I don't want to say I buy stocks and put them in the bottom drawer for life. It's not the case. But I think understanding what you own and why you own it is really important as we go into these periods, and doing that obviously before these periods start. And really look at these these aren't stocks, they're businesses. Like I was at Woolworths last night and Woolworths' stock price fell 3 or 4%. There wasn't 3 or 4% less customers in the store last night. I don't know if the business's value changed a whole lot. Just as, when markets are rising and say a stock's up 20%, maybe that's overdone. So I think just zooming out a little bit and just thinking about, okay, well, how does, as you said, Angus, Japanese central bank changing their interest rates really affect the long-term, earnings of a ResMed or a Microsoft or whoever it might be. And that's how I sort of try and rationalize it. And then I also try and sort of step away from the screens a little bit, in terms of, I'm not one of these people that, sit there and watch everything red and, start getting, like panicky and vice versa. When everything's going up, I don't sit there and, start high-fiving myself at all either. So I think that's how I sort of try and, that helps me, make sensible decisions in these times.
Yeah, and another way to think about it too that I have heard is it's good to panic early.
Yes, yeah.
Or at least sort of have in your mind, when you're making a purchase, thinking, well, what would I do if this went to here? And, at least having thought it through. But as a general rule, these are the worst times to, I think, you might get lucky, but I think generally it's when you're going to get really blitzed. Because for one thing, the algorithmic traders and your shops like Susquehanna and those sorts of guys, they love volatility. And you are going to lose against an AI on making a trade in short terms in probably at this point 999 times in 1,000. So really volatile markets. I think if there is an advantage that you have as a slow electrochemical piece of meat that's making judgments about businesses, whatever advantage you have. I think a situation of extreme volatility in financial markets, you do not have many of those advantages remaining. I think.
The advantage is that you have a long-term outlook.
Yeah.
All that volatility is great if you have a 10 or 20-year kind of time horizon. I love the quote, what happens in the markets today probably doesn't matter if you're investing for the rest of your life. I think that's pretty true.
Yeah, and do you guys? I know I do. I have probably 30 businesses on my watch list, and so I have an idea of what price I would pay for each business before one of these things, or before markets, have a pullback. And then I'm usually pretty confident if it's a general market pullback to actually buy businesses that have fallen below those prices. Whereas if one of those businesses on my watch list falls on a stock specific issue, I start researching it more and I start sort of maybe questioning myself a bit more. Whereas I actually like these periods because it's chaos all round rather than stock specific.
I find it much easier actually in these kind of periods to buy things than when stocks have just been going up for a year or two. That makes me feel a lot less safe. It's like, oh gosh, anything bad could happen and set this market on some sort of tailspin. Whereas now, at least you're in the tailspin, so you kind of know it's here.
Yeah, certainly if there's that opportunity to double down on a stock that you like, if you've got a small position that you've got some dry powder and you see something that's at a price that you wish it had been at weeks ago, then it's definitely worth considering. Is this a time to be buying for sure? I think just the main thing is just kind of not going off half cocked and selling and panicking.
Yeah.
Do
you guys in these kind of periods, do you tend to focus on using the kind of opportunity to buy the higher quality stocks, or because the lower quality, more volatile ones tend to have sunk further, do you focus on those ones?
I usually focus on the higher quality ones. What I actually noticed yesterday, I don't know if you guys did too, was it was really a rush for liquidity. So a lot of the larger market caps actually sold off more than, say, the mid caps or some of the small caps that I own, which was kind of surprising. And it was the same in the US. A lot of those big tech stocks, just because of how liquid they are, and people can use that to can sell them quite quickly. They sold off a little bit more than some of the other stocks on the market. So, but usually I would focus on higher quality names. But if a small cap that's maybe not as high quality as a larger cap business has sold off more and is below my price that I thought I'd be willing to pay for it, then I'm happy to buy those as well. Particularly in these, big market sell-offs. I think, that's where the big returns are. A lot of the high quality names, they might bounce back a little bit, but if a small cap sold off a lot, it can bounce back, quite strongly, and there's more of an overreaction sometimes in those names.
I think that's often the most secure places you can sort of go to if it is a real panic is in monopolies. I've seen people do that. They sort of try and find the most secure monopoly, and that's where they will sort of shift their money to in the time of chaos. But another thing I think about with this is I've seen studies and even speaking to people who have traded in moments where there's been things where if you had perfect information about how things were going to go, so for example, at the bottom of the trench during COVID, if you kind of had that data again and you already knew where it would end up, you still would not necessarily have done very well. Most people would have gone straight to cash. If they knew that COVID was just around the corner, they would have gone straight to cash and they wouldn't have done as well as they should have. So it's just so hard, even with perfect information. But I think, on that question of quality or, what you buy, I think too often I have not bought quality businesses at any stage.
Yeah.
But I've been trying to amend the errors of my ways.
What about you, Graham? Do you favour quality over something smaller?
I think I tend to, just as just because they're rarely on sale, and this is the only time that I feel like you can maybe get them a little bit on sale. So yeah, I'd rather the higher quality stock that feels kind of 10% below its value rather than, I don't know, a higher risk stock that feels a full 30% or something like that. So many stocks on our coverage list, they might get an upgrade kind of once a decade because they're just good businesses and everyone knows they're good businesses. But these periods at least give you a shot at owning them where there's a above average kind of margin of safety.
Yes. I do think it's worth reflecting on when you have these moments, it is a time of price discovery. And so I think it's sort of funny when you have, in that high pressure situation, to some extent there is a revealing of underlying worth. And I think maybe some of the narratives get stripped away from things because it kind of just, I think it focuses markets.
Absolutely. Well, we might move on to Microsoft and Google, two stocks that have been falling quite a bit. They have been participating in this large market downturn, and they are two quality businesses that, I would think at least members and other investors are interested in owning at the right price. Gus, you've been having a look at them, and the conversation shifted a bit recently from, these two stocks being benefits from AI to just how are shareholders going to get a return with the amount of money they're spending? And can you explain what's going on?
I think definitely those two calls in particular really showed the focus on AI that you've had from the sort of market obsession, and kind of you're starting to see a bit of a divergence in strategy and how that's being approached, both through a CapEx lens and through a product strategy lens. One of the things that I was so struck by with that Google call was that every single analyst asked about AI. Some of them had a follow-up question that wasn't kind of exactly about AI, and overwhelmingly the focus was really, well, what is the product strategy here? What are the actual things that you're going to be building? And one of the most interesting and revealing comments was that the CEO of Google essentially said, well, we see that the risk of not making this investment outweighs the risk of it being useless. That was sort of, his words were a little bit more nuanced than that, but actually not that much more nuanced than that. And this comes back a little bit, I think, to that discussion we had on AI a few weeks ago on the podcast, where it really is this, there's a quite academic argument about the potential advantages of getting an AI network to a critical scale and getting an emergence of superintelligence, which would obviously be hugely advantageous to a business. But that's very disconnected from the far more grounded kind of worldly discussion of revenue and products that a business sells and makes money from. And so there's a little bit of a gap there. And I thought the Microsoft earnings call Microsoft's strategy, the way that they're at least describing it, whether or not it's PR spin, but I think their product portfolio, I think, does appear to be better suited to be quickly and comprehensively integrating AI into it. Google's search engine, which is still the absolute key to that business, it's far more resilient than I think people feared, but potentially it is somewhat threatened by generative AI, or very significantly threatened in the long term. Microsoft, it can be adding these features to so many parts of its product suite, and even it's showing traction in its cloud AI products. It's sort of seems to have a better strategy, but I also feel that Google probably had that earnings call first. And I think Microsoft is possibly advantaged because they see where the media did not like what Google said and kind of can course correct. And I think there was quite a bit of that happening too.
Yeah, I think from my perspective, this whole narrative about their overinvestment into areas like artificial intelligence is important to discuss, but we have to step back and go, well, they can afford to make mistakes here. These are trillion-dollar companies. And also, if they're investing, demand for compute and data over the next 10 years is probably going to grow enough that even if these AI investments don't work, that excess capacity should be soaked up by that demand anyway. So I'm not too worried about that side of it. What I am sort of more interested in is just how these businesses are changing. So if we rewind, 10 years ago, even 5 years ago, they were sort of capital light businesses that we, and that's what investors, or that's what drew investors to them. Whereas now they're much more capital intensive. Return on invested capital has declined for the most part in most of these businesses, or is stable, and is forecast to decline because they've spent, I think, Gus, you might have mentioned about $44 billion from Microsoft alone in CapEx, which is kind of incredible. But we do have to think about maybe the return profiles, at least from a return on investment point of view, are going to be lower going forward. And then the other thing that I sort of worries me a bit with big tech is, for the most part, for the last decade, the regulation environment has been pretty good for them, and each company's sort of stuck to their own niche. Like, Meta has been in social media, Google in search, Microsoft in sort of cloud and productivity, Apple in phones, and there hasn't been too much competition between each other. And I think that's starting to change. I also think that the regulatory environment is starting to change a bit. And it's just hard to see how the next 10 years is going to be as good for these firms as the last 10 was. So I don't know if you guys have any thoughts about that.
I certainly think with Google, it's going to be a challenging environment. And it was interesting that overnight, I was reading early this morning, there was a big antitrust lawsuit you wrote about it a while ago, Nick, that's been, lurking in the wings. And I think most people anticipated that it wasn't going to be a great result for Google. I don't know if it was anticipated to be quite as bad as it was. So it'll be pretty interesting when it opens late tonight, our time, just to see whether or not it sort of sells off on this news of this lawsuit, on this judgment, because it was found that Google is a monopolist. And essentially this case was really looking at Google being the default search engine in Android phones, in Samsungs, in other, they pay a very, very large fee to Apple. I forget quite what it is. It's something like $20 billion a year, which would be a very high margin, $20 billion to make Google the default search engine. And there was some fascinating stuff because this law, I haven't read the full
200 plus page.
Yeah, I think it's 236 pages. But I've got it in the back of my mind that I might. But I read a pretty comprehensive summary of it, and there were things like this. This is amazing. So, 80% of Edge users. So Edge is the default Windows search engine. 80% of users will stick to Bing if that's up there. that they will just use the Microsoft search engine if it is not, the default is not set to Google. So Google is at risk there. If 80% of users will just use what they're given, then this is giving them significant, market penetration by having these sweetheart deals. But the number one search term in Bing is google.com. So there is actually, I think, a real sort of differentiation in the product. But some of the other really impactful aspects of this judgment relate to the judge really rejected Google's arguments about its need to have data. And they said, well, actually, it's this fair competitive environment and Bing can have just as much advantage. But Google holds data for 18 months. And the way that it's using that data, and this could have real implications for things like training generative AI models. There's a lot of stuff to sort of unpack in that judgment, and there is no doubt Google will appeal it. And it's unlikely that this thing, this will go through the courts for years to come, I suspect, or I anticipate. But this is sort of the gloss coming off one of these tech giants. And I think the two main themes of tech earnings more broadly, if we go beyond Google and Microsoft, of this earnings season that I've listened to, so companies like Qualcomm, companies like Intel had a disastrous result. It's been about AI, but it's also been about trade restrictions with China. And so companies that have exposure to China, there's been all sorts of their trade permits have been rescinded. And the companies where that happened have all been hit quite hard. So we're just moving into a very new world. And I mean, I guess we're always moving into a new world, right? It's kind of a stupid comment, but it's an uncertain time.
Graham, have you got any views on this new world?
Not especially. I wasn't particularly good at predicting the last world, so the new one's going to be a mystery too. But I don't think Google being a monopoly is really anything new. I don't see why the court case changes all that much, really. But from what I understand, and I don't have a perfect understanding of it, but the US would kind of need to change its laws around what monopolies actually are for it to have any major impact on Google, because so much of Google's stuff is free. So it's hard to argue that it's abusing its pricing ability or anything if it's giving away the products for free.
Yeah, it's a really interesting one on that. This just because I think I forget his name, but one of the lead prosecutors came out after the judgment and said, "Oh, it's a great day for the American consumer." And I don't know if really much has changed, to be honest, today after this result. But I think the sticking point in the case was the money they're paying to be the default that Angus mentioned to Apple and to Samsung, and maybe that's anti-competitive. As you said,
I don't know if there's got to be a default. Then I feel like it's fair that someone pays for it, and then that's just an economies of scale issue that Google is the biggest, so can pay the most. And
I think an important lens to look at through this, it's not so much the lens of me using Google at home. It's how it manipulates the entire market for other market competitors and for customers that have to pay Google for ads. So one of the things that Google got flogged on in this judgment is that they have just been increasing the prices on. So they're creating this environment where if you're the local plumber, the only chance you're going to have to get found by anyone in your area is by paying Google for ad placement. And the way that they charge customers for those ad placements and the way that they operate that ad marketplace is super anti-competitive. And I think it's more about the kind of structural elements and the sort of B2B side that has been particularly kind of called out as monopolist. So I think there will probably be changes, but to that earlier point, it is still an incredibly good business. I think I don't think it's, and I think there are all sorts of aspects to this business that aren't really impeded by this. But will it be able to retain the dominance that it kind of has had? Though interestingly, Google's never traded it really, or not since I've looked at it, which is quite a few years now. It's never really traded at that crazy a multiple. It's sort of
no, it hasn't.
Yeah.
It's always been sort of that, 18 to 25 times.
Yeah, low 20s kind of thing.
Yeah. And that probably is, I think that's probably fair in terms of investors have obviously made the determination that Microsoft's much more entrenched and its moat's much more secure. It trades at sort of 35 to 40 times and probably has similar growth rates to Google. And I think that's probably a reflection of these regulatory risks and just, not only artificial intelligence, but that, as you said, Angus, that the default option is, it's a big thing here. I forget what product it was. It might have been Maps or one of the ones that they had on the Apple iPhones, though, was default, and then it was changed from the default, and it really affected usage. Not a lot of people actually, most people stayed with the default option. I think that scared Google, endlessly, and so that's why they've been happy to pay Apple and Samsung, tens of billions of dollars to remain the default. So. Yeah, there's definitely a threat to the business that's worth thinking about, but maybe a bit of that's in the valuation at, I guess 20 times or 25 times earnings, something like that.
Mm.
We might switch tack and talk about another high quality business, Graham, that you cover, ResMed. I feel like it was only 6 weeks ago we were discussing how the stock was under pressure from weight loss drugs, but now Mr. Market seems pretty happy with it. I think you upgraded it too then, so good job. I think it's risen like 20% since, and its full year result was fantastic. And the CEO is now even suggesting that weight loss drugs aren't a threat; they're actually a benefit to the company. Is that too far? Is that a step too far, Graham?
No, that's pretty much exactly what he said, which surprised me a bit because I think there's something to be said that the weight loss drug, even though we kind of came to the conclusion that weight loss drugs wouldn't have a major long-term impact, it was interesting that the CEO kind of doubled down on it and instead of just almost in a Trumpian kind of way, took the fact and just decided to go all in on the opposite. And so rather than saying, they might be a threat or brushing it off, he says that they'll actually benefit the company. And he had some data to back it up because a study came out that found that people were around 10% more likely to start CPAP therapy if they were on a weight loss drug. So there might be something. That surprises me. Yeah, it might be something to do with people kind of wanting to take control. I remember a study in, I think it was, the name escapes me, but in psychology they found that people would have their depression and anxiety improve just by the act of going to a therapist. It didn't actually matter so much what the therapist was doing with them, but taking control kind of helped them out. And in this way, I can see a similar thing happening where once people start the weight loss drugs, that's them taking control. It's a big boost to your, effort and willpower. But then we find that weight loss drugs tend to only have a retention rate of around a year or two because most people don't like the side effects of them and so quickly move off them. And so what they're left with is, I decided to attend to my sleep apnea. And what's the next alternative? Well, it's probably CPAP. So they then start that. Maybe there is something to be said about weight loss drugs being a net positive, but I think it's a bit early to call that. I also think it's too early to call that they're a major negative.
Yeah. It did seem like a little bit of, that it was limited data to, make great conclusions from. But the result itself, I had a quick look at it last week. It was sensational. I mean, we're talking about double-digit revenue growth, operating margin expansion, some buybacks. It was
the gross
fantastic.
The gross margin improvement was really impressive. I thought that was up 3.5 percentage points, which basically reclaimed all of the lost ground since the pandemic. So it's now a much bigger company with an equal margin to what it had prior to the pandemic. And its cost-cutting program basically eradicated all of the issues that it had with rising, just general inflation of the cost base, higher freight costs, and all kinds of other things thrown in there. It was a very good result for ResMed and nice being a buy recommendation of ours.
Yeah, and it seems, I had a look this morning, it seems still pretty attractively priced. And we're talking about 24 times next year's earnings for a business growing double digits. I mean, that's pretty rare in the Australian market for such a high quality business. I know it's dual listed in America as well, but I was a bit surprised by that. And Ozempic remains a threat, but it's got a large addressable market ahead of it, and we could look back and this could be, still a buying opportunity, I think.
Yeah, even kind of in looking at worst case scenarios for the Ozempic effect, the market's still multiples of the size that's currently being attended to by ResMed. So there's plenty of room to grow, even if you assume that that Ozempic and other weight loss drugs have this really drastic effect on people being cured of their sleep apnea. So yeah, there's still a buy case. It's not too far from our buy price, which means that if we have a bit more market volatility, maybe you'll get a second shot at it.
And yes. How did it respond last night in the volatility?
I don't know. I haven't looked this morning.
I actually think it rose yesterday. It was one of the only stocks up in the ASX 200, I think.
Interesting. Well, that's a good sign.
Yeah, I guess it just goes to show how good that result was. Do you have any views on ResMed, Gus? Is that one you'd like to add if it did pull back?
I think it's an interesting business. I'll be honest, I've not done the work on it, but I've been impressed hearing about it from Graham. It sounds like a something to definitely look at, and I always like when something's at a nice price, that's for sure.
Well, on that note, we might leave it. Graham, thanks for joining us.
Thanks, Nick.
Gus, thanks for joining us.
Thanks so much.
And for everyone else, thanks for listening.